And a similar growth forecast from the Mastercard Economics Institute as well. In its latest annual outlook, economists expect growth in the Asia-Pacific region to remain broadly stable next year, even as the world braces for another year of geopolitical tensions and trade disruptions. Globally, real GDP growth is expected to ease slightly to 3.1% next year. Asia-Pacific is expected to be supported by easing inflation, supportive monetary policy, and rising household incomes, with travel remaining a major engine. The Mastercard says the region faces a complex year ahead, but notes that how governments and businesses respond to these changes will shape the next phase of growth. And for more, we're joined by David Mann, Chief Economist in Asia Pacific at Mastercard. So, David, thanks for joining us.
Thanks for having me today.
Yeah, and your latest outlook shows a slight easing in global GDP growth, but Asia is looking pretty stable. And you've pointed out easing inflation, supportive monetary policy, rising real incomes. But which is the biggest driver in your assessment?
Well, the way that we looked at it when the whole of the Mastercard Economics Institute was trying to come up with the 2026 outlook, thinking about all of these major swing factors, and you mentioned geopolitical tensions, you mentioned the trade issue, so many things that really were very big shocks, but the resilience to that shocks this year has really been quite impressive. Take the example of China, as you mentioned earlier. If anything, it's actually seen a slight upgrade to its overall growth projections, even for the present year. And we think next year it goes to, say, 4.5%. That resilience and strength also we see in India, where, again, it's less trade impacted, but clearly it is the fastest growing major economy in the world this year, and we think in the foreseeable few years to come. Now, of all those factors that you mentioned, the ones that we think about the most will be, of course, the inflation-adjusted real incomes for consumers. That's really what it will come down to, because the consumption side of the economy is the one that we're, of course, most focused on. And we know that we've been seeing for a few years in some places the cost of essentials had been rising so much relative to wages. But now we're in a world where we're seeing it the other way around, where instead we actually are seeing wage growth exceeding CPI inflation. And on top of that, some drivers are really playing a big role in that. Firstly, you have lower energy costs. Very good news for consumers. It's effectively a tax cut, you could think of it, of something that people will be doing every day, but they're paying less every time they fill up the car. On the second front, you also have lower cost of funding, lower interest rates. And then because of the trade war, we also have been seeing the impact coming from lower cost of goods from China. And that has really been, I think, shown very well, because year to date, we've seen a new record for a trade surplus of China with the whole world, even though we know its shipments to the US have been well down. Now, that we think is the story for next year of cheaper goods for so many consumers. Good news also. But it also does mean that when we think about where China's companies want to be producing from, knowing the risks that there are, and also the demand picture not being as strong today in China as it had been in previous years, there's still a lot of growth that comes from all over the Asia-Pacific region. And we think, therefore, producing in and then selling to markets in the ASEAN region or in India also makes a lot of sense for those companies as well.
Yeah. Another key driver that MEI noted is travel.
Yes.
But we're seeing, of course, some geopolitical tensions in this part of the world, Japan, China. I mean, how much could that affect momentum? What will you be looking out for?
So in particular, the latest diversion of some of the outbound travelers from China to elsewhere is something that we are focusing on. And interestingly, because Japan itself as a destination has been literally the fastest growing, the booming inbound market, even globally, certainly within the region, we think that any drop-off that there may be in flights to parts of Japan would easily be taken up by other markets very quickly. You just think of, say, outbound markets like Singapore. It's a great example. Hard to find someone who hasn't wanted to or already gone to Japan for a holiday if they were able to. And so there will be that demand that will be filled up. And already anyway, Japan had been, and we think for next year, it's close to that saturation point in terms of just how many flights can you take in, even if they're all full, how many more passengers can you really squeeze in every year on year if you don't literally add a lot more airport capacity. So it's already maxing out in that way, we think, for next year. Meanwhile, other markets could see some of that diverted flows as well. So it could be coming from China, inbound into, say, Korea or into other near neighbors, but also down in Southeast Asia or further afield in the Middle East and Europe too.
Yeah.
And so in that way, we're not too concerned about that really being a major drop. If anything, it means a little bit more demand diverted, say, into the ASEAN region.
Right. And you also pointed out AI tech, seen as possibly offering a meaningful boost to growth. I think one development that we've been watching very closely is the U.S. allowing, these shipments of the more advanced H200 chips into China, NVIDIA chips into China. I mean, what this thawing of U.S.-China trade relations, what this means for, or how do you think this is going to reshape the landscape here in Asia, the supply chains, especially with chip names in Asia, kind of the bigger performance of this year? On one hand, this is a welcome move, right? Improved relations, but what does it mean for competitiveness?
Well, it is certainly very good news if we're seeing these improved relations, less tensions, less friction, and therefore less inefficiencies in the whole system. We know that China is doing very well on advancing its own AI development, even with the chips that it does have available to it. So if it's able to use even more, that's of course going to be helpful. But actually developing their own chips is also a key priority of making sure that they can become also as competitive and as strong as some of the leading edge chips that we see today. So more investment in this space is unquestionably happening. Either way, this probably boosts it a little further. The key question, though, on AI itself is that short term, we see so many more use cases, so many people finding how it supercharges their productivity during the day on so many different tasks that people do in whatever type of work. The coming years, though, the question will be, is that productivity gain going to be reflected broadly across consumers? Or is there also the challenge of some frictional unemployment that can also come alongside this in the years to come? We don't know exactly how rapidly AI becomes super intelligent, for example, or goes all the way to being able to do so many more tasks than we can even imagine it doing today. That's the bigger uncertainty that really we just don't know at this stage. But short term, the exciting part is really there. And we're even seeing it, say, in our own business when we look at things like agentic commerce for reducing friction in the e-commerce space.
Yeah.
So a consumer just says what they want into a particular function, an agent, and they go and help them figure it out and get the best deal for them straight away. That's good news for consumers.
So hopefully we'll see, get a clearer picture next year from the clues we're getting. David, thanks for your time. Thanks for making time to join us today. David Mann, their Chief Economist, Asia Pacific at Mastercard.